Today, folks, I am getting absolutely wrecked, as I'm sure you are as well, down several $1,000s this week. The only thing keeping my portfolio at parity is what? Well, I work a regular 9 to 5. I'm stacking up that cash, baby. I'm putting it in my tax advantage accounts. I'm getting some tax returns from the government, and I'm using that money today, and I've been buying stocks right now. We're going to discuss the stocks I bought, why I bought them, the ones I want to buy that are on my buy list, when I plan on buying those, and so much more in between. So damn it, hit that like button, because if I've been wrong, yes, on some timeline, but I've been right about the AI bubble. At least I continue to think that I am, because we are seeing a deflationary period in the bubble that has been AI when it comes to the chip sector, when it comes to AI stocks, and it is now pulling down the broader big tech giants, baby. But the rest of the market, we've seen some earnings. JP Morgan, Procter & Gamble, the numbers actually pretty good, yet the stocks dropped on those earnings, which had me a bit concerned that we were in overbought territory, but those stocks have now recovered, showing some sign of strength. We'll talk about those in a moment as we get into earnings next week with Tesla, GM, UPS, Visa, Pepsi, Meta, Microsoft, Google, hell, Altria Group, all your favorites and your oil giants and your healthcare, which is going to be true defining moments for where the market goes moving forward. And I don't think we're going to get a huge correction. I don't think we're going to get a huge crash. A lot of people are bearish as hell now, which makes me want to buy stocks. I honestly think we're more in a period that's relatable to 2023, the end of July to the October bottom, where we corrected about 10%. I wouldn't be surprised if we see about a 10, maybe 15% correction. Could be more, could be less of a black swan event persist in these geopolitical events, but I highly doubt we're in a period that's similar to 2021, 2022, the interest rate cycle that took the market down 25%, give or take. I mean, you take a look at the last 5 days, though, we've given up 4% of the market returns already, which is why next week earnings are going to be so pivotal. Now, when it comes to these earnings, yes, the AI-oriented stocks are going to get, I think, wrecked. I don't think there's good enough earnings to justify Microsoft trading at a 36 times multiple, already down 6% this week. And I'm only saying that because if you look at the revenue growth, they're trading in the higher teens. I mean, they've recovered back to about 17% based on last earnings. But I mean, if you go to 2021, they were trading over 20%, upwards of 22% revenue growth, right? But when you take a look at, again, the price to earnings multiple, they're at the highest level they've been at in basically a decade. And even if you go back to 2021, they were trading around a 30 to 35 times multiple, and they were growing a lot more. So I think there's still some correction room here unless they absolutely crush it and blow it out of the water, which I'm having a hard time believing right now. But you look at companies like Apple, this is one of those stocks on my buy list for diversity. We'll talk about that toward the end of this video. But Apple, I don't think the earnings are going to be explosive. This will be more of a recovery play toward an interest rate cut cycle. But I love Apple trading at a 25%. I love that it continues to go down with the broader market, and it is one that I have on my watch to buy list very, very soon. Amazon e-commerce is no path to slowing down anytime soon. I think, Amazon could still be a reasonable buy here, just peaked all-time highs and has now pulled back. Last 5 days down damn near 7.3%. Meta, an AI play. This one is give or take for me. I think it's trading at a favorable multiple for its recent earnings and how fast it's recovered its growth. But again, it is playing heavily into the AI story, and will be neat to see what the earnings bring for it, because I think at a 31 times multiple, could be just here if you're a Meta fan. I mean, it could even be a buying opportunity. I think maybe 450 might be better, but time will tell. Google has not corrected as much as the rest of these stocks have this week, because I think Google, again, was one of the cheapest AI plays that was largely unrecognized, only down 3% this week, holding highs beautifully at a 28 times multiple. I think we're good with Google. Like I said, I think Google could correct a bit more, but it's going to be slower than the broader market, just depending on how earnings go. Tesla wrecked. Oh my God. Whoo, baby, I'm down 13% on the position I started just this week. That's painful. I'm really expecting this to get down to probably about 1 to 150. If it goes below that, my jaw will hit the floor, but I'm waiting until after earnings, as I do plan on picking up some more shares. But again, I'm just going to wait. Every time I've been like, it's good buy. Oh man, 140, I should buy here. But I'm like, let's just give it another week. Just wait till earnings. I don't think there's anything on earnings that is going to blow the stock out of the water. So there's more downside likely to persist. Netflix, I think, is the first stock to really start reporting earnings in the FANGs. And when you talk about FANG stocks, there's a lot of cyclicality to Netflix. I don't think it resembles the big boys like Microsoft or Google or Facebook in a sense, because, Netflix went through a period of increasing costs, getting rid of password sharing, and it really helped drive a lot of the recent growth. And recently they've, trouble sustaining a lot of the growth moving forward, because that stuff is very cyclical. It only lasts so long. And, it's a completely different ball game. I don't like putting Netflix in the FANG kind of companies because there's so much competition. And I really don't like entertainment-oriented companies outside of Google and YouTube because big media is very expensive. There's not a lot of returns, and margins absolutely suck. So I'm avoiding that, but it is a sign of a correctional period. And we've also got the big chip stocks, which posted in guidance with some of their earnings. ASML here we talked about the other day, now dropping. It's down 13% from the recent highs, and I think we're going to persistently see tech stocks or chip stocks drop dramatically. Taiwan Semi down 9% this week, posting earnings that were really good. Super Microcomputer, I don't think it's posted earnings. It's down 21% this week. I mean, you look at NVIDIA, 12% drop. I told you eventually NVIDIA is going to hit parity with the market. And when it hits parity and that growth rate completely levels off, guess what? It's going to be hard justifying that 70 times multiple. Hell, we're already down from the 70s into the 60s. I wouldn't be surprised if we get down to the 50s or 40s if earnings just can't keep up. They really have to blow it out of the water, really, like the way they have in the past, and I just don't believe it. It's already slowing down. Told you guys, got to be real careful buying these tops. People didn't want to listen to me. They kept yelling at me. They kept unsubscribing from me, but we're already down 20% in NVIDIA. Could have saved yourself 20% from buying the tops here. I'll even at least 10 or 15% if you've been buying over the last couple months. You got to take it patiently here, guys. Recognize values, trends. Be careful. Be cautious. It's scary out there. JP Morgan posted, right? And we saw it drop, but it's actually been leveling off and recovering a little bit into the end of the week. I mean, we saw Johnson & Johnson, which I haven't even looked up here, but if we take a look at J&J stock, let's see how it's been doing, because it was another one that dropped and has also recovered this week, kind of giving back some of those losses. Abbott Laboratories dropped on earnings, now recovering. Again, these are good signs that the market was overbought, but is leveling off even against the good earnings these companies have posted. You look at Interactive Brokers, this one actually jumped on its earnings. These lower end of the market kind of companies, they're what is going to sustain any fallout that we have in these big tech companies. Though you can't avoid the fact that tech companies make up like 30% of the S&P right now. It's a pretty large holding. Procter & Gamble posted, and same deal. The stock dropped miserably and then immediately recovered into the day. So Procter & Gamble, I think, is a good defining of what like the average consumer staples doing, because there was a lot of fear that these stocks were having a hard time with the price increases and the gouging that they were doing. But basically, they lift annual profit forecast on strong U.S. consumer demand and easing costs. So the fact that we're in this inflationary period, which I think is over. Inflation is primarily driven by housing, oil, and doesn't really have a lot to do now with end consumer products and commodities. Procter & Gamble's been benefiting greatly from this. Like, they've been seeing margin increasing even though net sales have flatlined, right? Like, if you look at the cost of products sold, they've dropped by $500 million in value. That's pretty great, right? It's been increasing their gross profit by 7 percentage points. So I think this is a good sign for the underlying economy that things are starting to normalize. They're making more money on interest income. I think we're going to see this with a lot of, insurance-oriented companies like Berkshire Hathaway that have a lot of cash. I think companies that are a lot more stable, that are more leaning toward oil right now, that's been up a lot, are going to continue to benefit greatly into this earnings period, right? And likely into the next quarter. So if we take a look at my portfolio, what have I been buying? Well, stocks that kind of coincide with that. I've been buying VDY. I think the Canadian markets are going to do exceptionally well. I think we're going to see some bank recovery. I mean, we recently saw some big growth in Royal Bank because it purchased HSBC. I think that's going to start to, add to the earnings per share, the bottom line. If we even take a look, right, at VDY, the holdings that kind of sit in here, a lot of these companies I think are going to benefit greatly this quarter. I think the banks are going to continue to recover. Debatable with some of the recent, regulatory stuff that has changed. It's going to cause them to lose some money, but I think we're still doing pretty well a lot of these stocks haven't hit all-time highs. Most of the banks are nowhere near all-time highs. It's not like JP Morgan. We're not anywhere near close to that, right? But I think we're going to see some good stuff out of Manulife. The insurance companies, I think, are going to continue to post great numbers. And again, if you take a look here, like Enbridge in the oil game, this one's been down all year despite oil rallying. Again, Toronto Dominion Bank, the second largest holding in VDY, is trading down still. Like, it's barely got a blimp in recovery because of some stuff that probably isn't going to materially impact this earnings period. Royal Bank, again, just went through that massive HSBC purchase that should start adding to that bottom line. So I think there's a lot of benefit that I'm going to be seeing by buying this ETF right now and offer some stability against the backdrop of this horrible US market that we're heading into. So what I'm looking to do with my US stocks is, again, I'm not buying any more Google right now. I haven't bought any more S&P 500 yet. I'm still just holding off, being patient here. Tesla, again, I'll buy more toward the latter half of its earnings. We'll see what happens the next day or two after the earnings post. But when it comes to these stocks, like, I'm down about $1,400 right now. I've got another couple thousand in cash, another couple thousand just sitting in my savings account still. Like, I'm going to have another 4 or 5 G's to invest. And again, I'm just going to do this a little bit more methodically, but I want to start getting aggressive if we keep seeing these dips. And I'm going to be saying that I'm buying things like Apple because, when I look at the combined portfolio of mine and my fiance's, we are a little under diversified in some tech companies I still want to expand a bit more. Apple only makes up about 1.8% of our combined portfolios. Microsoft doesn't even make 1% up. Keep in mind, though, those are heavily weighted in the S&P 500. On an individual basis, I feel like we could have a bit more exposure, especially with Apple now trading down. And that's what I told you guys. Like, I'm looking for the companies that we don't already have exposure to when they start trading off their highs, that's when I look to accumulate. I did that with Google. It's been working to our favor. Meta, we ain't buying anymore right now for sure. And Tesla, I have been slowly buying into, and I'm going to continue to get a little bit of a bigger position. But the three stocks I'm primarily looking at will be Amazon, which I just didn't have enough capital to buy it on its dip. I focused more on Google, but now I'm looking into Apple. So we'll see when those start to make bigger positions within our portfolios, but it'll be relatively soon because, again, I think they're trading at more favorable value. So the broader market is a mixed bag. I thought we were going risk off, but crypto's actually holding up pretty nicely with the big megas like Bitcoin. I think what we're just going to see is a cyclical move out of a lot of these AI overhyped stocks that are going to start reaching parity with that absurd growth that we saw, just kind of triggered by ChatGPT. And, it'll still be good growth rates. We just need to see a correctional period. And again, I don't think this is like the most bearish market that every investor is touting right now, like cash, cash, cash. I've never really been a cash guy. I've always kept about 5 to 10% cash in my portfolio. It'll always be that way because I just like having it for these big drops. But I also just like having a base of protection against my portfolio. I'm not that crazy to be all in all the time, but I consider myself a relatively conservative investor. A lot of people think I'm much more, in depth, like going crazy. I have been buying some more individual small penny stocks on the Canadian side of the border. I'll talk about that earlier next week. I don't talk about my small cap plays as much because I don't like, touting some more of these speculative investments unless that's for you. You can watch those videos. But at this point, I'd love to know what you're buying. How do you feel about this market? Let me know everything and your thoughts in that comment section below.